to solve. That is the latest exam of ACCA, which is we call the latest exam of ACCA March June 2025. It's one question we need to solve, and we will be talking about how easy the exam is. Now, let me do some generic discussion before I proceed to solve the question. Just a minute, I'm connecting my iPad. So in this past paper, which we are going to talk about, March, June 2025, in this, it's question number 1 we need to solve today, which is 50-mark case study. We will be discussing today itself. And most probably, if we have time, I might be doing question number 2 as well today itself, and question number 3. So analysis of the question. Question number 1 is on mergers and acquisitions. And typical question, repeat telecast. There are 2 to 3 types of questions on merger and acquisition which are repeated. Question number 2 is on interest rate futures and options. And question number 3, that is financial performance of the company. Very, very easy. This is financial performance of the company, which you have been discussing since long in your previous, means the subjects. It is the continuance of that with some variation. The question number 3, that is financial performance of company. So hence the paper is very easy if you know those basic topics. So in my opinion, AFM exam can be passed if you use some practice questions under timed condition. Only one challenge. What is challenge in AFM? That is time management actually in exam. Because there is a lot of information, a lot of calculation, a lot of discussion to be done. But still it is manageable. That's why it has huge pass rate in the exam. We know that. So now, the question number 1, mergers and acquisition. So in the mergers and acquisitions, as I told you, there are normally the questions which are tested. They ask you to value a company, any method, P/E ratio method, cash flow, free cash. So either they mention some specific method is mentioned, or mentioned, or they ask you, or they provide you data in question speaks. So data in the question speaks which method need to be used to value a company. Or sometimes they ask you to calculate, yes, the percentage gain in terms of different considerations. That cash offer to the target company shareholder, what is the percentage gain? Or share for share exchange for the target company shareholders, what is the percentage gain? Or sometimes they ask you to calculate amount of gain as well. Or the third is, sometimes they ask you what maximum premium which can be paid on acquisition. So you see here, these type of all questions, they are repeatedly being tested. So what do you have to do? You must know the valuation method. In this method, in this question and in this question, normally you need to calculate post acquisition values, market value of equity, and pre acquisition market value of equity. You need to calculate. Yes, there is another question arises in my mind. Sometimes they ask you calculate the value of synergies. Now, what is that? I will talk about that as well. So, post-ACC market value of equity. So, you need to calculate of combined company. And pre-ACC market value of equity of both companies, acquirer and target company, both. Once you have calculated these three values, one value, two value, and three. So you calculate basically, yes, the value, additional value created by acquisition. This is what you calculate. Additional value created. How? Post-ACC value, this 1 minus 2 minus 3. You deduct that from it, and that is the additional value created. That is the additional value created. And this additional value created by acquisition, this is actually value of synergy as well. Total value of synergy. Same. This is the amount which can be paid as premium maximum, because this is additional being created. This is the additional being created. Okay, the same amount. So you see here. And now, in order to calculate percentage gains, again, you need market value of combined company and market value of share of individual company. So percentage increase, even amount increase in the wealth, you can calculate. What is the value per share now before acquisition? What is value per share after acquisition? What is the value of share after acquisition? So amount of increase and the percentage increase is calculated very easily. So these are the questions which are normally tested in exam. Now, a similar question, which is I'm going to share with you the latest exam paper. Just a minute, please. Here we are. This is the past paper, March, June 2025. And you see here, the requirement is here in front of you. Prepare a report for the board. Prepare for the board of directors, report for the board of directors of Kampai company, which includes what? An estimate of Kampai company's PE ratio. One thing, an additional equity value generated from acquisition. Now you see here, same. An estimate of percentage gain of wealth for Kampai company and Sky company's shareholders under the cash offer. Next part, an estimate of number of, now you see here, reading, this is a bit different question, a bit different, a bit twist is here. An estimate of number of Kampai companies share allocated to Skull companies shareholders and percentage gain in shareholders' wealth for Kampai company and Skull companies shareholders under the share for share offer. It has number of requirements. Three requirements are there in this question. 3 requirements. 7 marks.
Now, a discussion of acceptability of cash and share offer to Kampai company and Skull company shareholders, including the assumptions made in estimating. Now, assumptions made, acceptability, 7 marks. A discussion of the financial issues faced by Kampai company when acquiring Skull by cash, and briefly conclude whether a mixed offer would be a better choice. No additional now discussion. A discussion of how Kampai company's board of directors might address the negative comments made. Now, this is generic question. This is what I ask normally my student. That in AFM exam, you must expect up to 15 marks parts. This is 7 marks, by the way, which you may think this is, I have not studied it anywhere else. Rather, that will be, those parts will be from your general knowledge of financial framework. So basically, your professional judgment as a finance manager, that is applied over there. Your whole mindset developed, that is to be tested over there. This is what is happening here in this part as well. So now let us proceed further. Come here. So now, Dariku, now how to start solving the question? Just see here. Before starting solving the question, you need to create a structure of the question if you want to save time. So, for example, the structure of the question will be over here. Since you need to create a report, all the requirements you must be able to write over here. For example, here you will write report to the board of directors, Kampai company. Yes, Kampai company. Okay, introduction paragraph. And then you will create, you will need to do calculations. These calculations. So which you will write here as summary of results, summary of calculations. The next part is discussion. Discussion of acceptability of offers. Discussion of of acceptability of offers and assumptions. Next. The next is, yes, financial issues by financing issues. Yes. What is the benefit of it? What I'm doing? When you create a structure at the start of the question, you have the whole idea how much I need to cover in the remaining time. So you will be spending, I suggest to you, 100 to 105 minutes, 100 minutes on this scenario one. Okay, 100 minutes on it. Financing issues faced by Kampai company. Yes. For acquiring cash and offering mixed offer. Next, the last. The last heading is factory closure and addressing negative comments. So you just create a structure over here. Now everything is in front of you. And at the end, conclusion paragraph. Report compiled by. date. So now this is the whole story. Structure is there. You have to fill the structure. Let us start with the first part. So now how many appendices you need to create? One, two, three, three appendices, three calculations. You will open the spreadsheet, give the heading appendices, appendix one, three appendices, and you will start doing it. Simple is that. Okay, so then appendix 2, for example, it is completed here. Appendix 2 and appendix 3. So, what is the benefit of it? Creating the structure. Before starting reading the question, you have analyzed the question in requirements in detail, first of all. It will not be the rough reading of the requirement because you have to create headings. So, requirements you have grasped. The whole scenario requirements are in your mind. Now you have an idea what to read through the scenario. Okay, now, so the first requirement. So Kampai company, the large listed company involved in the production of machinery for the logistics industry. Recently, it has been growing successfully by undertaking strategic acquisition of competitors' companies. It has made initial inquiries about acquiring Skull Company, a large unlisted company. This would be an important strategic acquisition for Kampai Company. Kampai Company has a good reputation both with both investors and also with other stakeholders. The company is well regarded for making a positive impact on the environment and also looking after its employees. It is doing well financially, and share price has outperformed the market. Skull Company is involved in the production of vehicles for the logistics. Okay, machine industry. It is regarded as being an innovative company which puts sustainability at the core of its business operations. Its most recent venture has been establish a factory in less developed part of the country to produce vehicles running on hydrogen beneficial for the employment prospects and system. Now, this information might be used in the discussion areas. Keep that in your mind. This is not just information for the sake of introduction. You need to grasp it. We may need to refer it again. Ideally, we should not be able to. We should not be needing that now. So come here. Financial information. The first requirement is PE ratio of Kampai company, an additional value generated from acquisition. Okay. So Kampai company, it has 225 million shares trading at P. Price is here. Number of shares. Profit is here. So PE ratio can be calculated very easily. It is very easy to calculate PE ratio with this data which is available to us. So how to calculate? Let's see here. So number of shares, 225 million. Market value per share. It is given. This whole data is given. I have not written from my side. So total profit after tax is given. So how PE ratio is calculated? So total market value of shares. So price, and this is profit after tax given. So PE ratio is here. Price divided by earning. So one calculation done. Now, the next is Kampai company. You have to stick to the requirement. Kampai company's board of directors is proposing that Skull company is acquired either through a cash payment of $8 for each Skull company share, or through, now this is for the next parts. This is for the part 2 of the question, if you remember that, cash offer. Okay? Or through a share for share exchange where a number of Skull company shares are exchanged for a number of Kampai company shares. Such that now this is the twist I told you. This is twist. Additional value created from Skull company acquisition is allocated 50% to Skull company and 50% to Kampai company shareholders. Kampai company's board of directors has held initial positive discussion with Skull company's board of directors and majority shareholders. Skull company's board of directors and majority shareholders have indicated that a premium on the current value of Skull company of at least 25% for the cash offer and 33% for share would be accepted. Now, this is acceptability of the proposals. Discussion. The part. Acceptability. Acceptability. This will be used over there. This would be in line with the market-based premiums paid for. Now, you can identify this data only when you have analyzed the requirements properly. Otherwise, what will happen? Majority students waste their time. They don't grasp the requirements first. They go start reading the scenario. And this they do not analyze the scenario well then. Okay. Now what we are looking for? Percentage additional equity value created. So how additional equity value created can be calculated? Tell me how. We have to calculate the current values of the both companies, Skull company and Kampai company. Then post act total value of the company, combined company, right? So total value of the combined company, right? Skull company has 40 million shares in issue and has 80 million of long-term debt on which interest is paid on annual rate of 6%. Skull company's most recent profit before interest and tax was 26.3. After deducting 16.2 million tax allowable depreciation and other non-cash expense. Skull company makes an annual investment of this on non-current and working capital. It is estimated that company's cash flow will grow annually by 4% for the foreseeable future and the cost of capital is 11%. Tax rate from now, what you are getting it from this data? I told you data will tell you which method to use for valuation. It is free cash flow to firm. Data is given. The whole data is provided. You can value Skull company pre-act value from here. So post-act, if the acquisition goes ahead due to increased efficiency, reduction in duplicate cost, company's profit after tax is expected to 4.8 million annually. And its P ratio is expected to same as Kampai company's P ratio. Additionally, there would be an immediate one-off increase in the cash flow from the closure of Skull company's recently established factory, which is producing hydrogen power vehicles. Yes. So now, what is going to happen? Focus, everyone. So we need, this is post-act data available. This is pre-act. So first of all, we need to calculate pre-act value of Skull company. Just see here. How? Just a minute, please. Okay, this PBIT, profit before interest and tax. It is given here 26.3 million pre-act. Now, what we are going to calculate? We are going to calculate market value of Skull company as well, pre-act. So for that, we need net cash flows. What is the value of equity right now? So tax to be paid. Add back non-cash expenses. Non-cash expenses added back. Then capex, capital expenditure, which has to be deducted. You see here, add back non-cash expense, less capex. So net cash flows of the firm. So now 4% increase in the cash flows. Cost of capital is 11%. So tax is already paid, yes. So just see here, it is perpetuity with growth. This cash flow into 1 plus 0.04 divided by R minus G, perpetuity with growth. So now, value of equity, market value of debt is here. So market value of equity, this minus 80. So it has 40 million shares in issue. So market value per share pre-AC is here. Now, for post-AC, we can see the data of profitability is given to us. And that is based on Skull Company's data. Kampai Company's PE ratio can be used, and this will be the profit. So just see here. So pre-AC profit, because they say due to increased efficiency and duplicated costs, Skull Company's profit after tax is to increase by 4.8 million annually. 4.8 million annually. Which means we need to calculate current profit first. So pre-AC profit, this is the PBIT, profit before interest and tax given to us in the scenario here. Then interest has to be deducted. Then profit before tax, then tax has to be paid, and then profit after tax. So post-tax profit will be additional 4.8 total profit. And then they say PE ratio as that of Kampai Company's PE. Current PE ratio, which we calculated above, this one, 18, it will be used to value it. So PE ratio into profit. Now, what is this 42.3 million? This is additional cash flow from closure of factory. You close a factory, you get cash. This is the value of equity plus additional cash you are receiving. Now, any questions so far? Equity value. So this is post-AC equity value. Post-acquisition equity value in front of you. Now, value of whose? Value of Skull Company. What is the additional value created? This is additional value created. That you deduct pre-AC value of this company from it. Now, this is a different type of question I'm telling you. I told you from this aspect. Normally, what we do, we add the profits of both companies and synergies and calculate. But here, this question is different. They have given us that additional value created for the data of target company only. The target company's post-tax value. On the basis of that post-tax value. So additional value created is here. This was a requirement. That what is the additional value created from acquisition? Right? Once again, come here. What we did, actually. We calculated the current market value of Skull Company using free cash flow method. But post-tax data is profits based given. So we need to calculate post-acquisition profit of Skull Company, which is based on pre-ac profit. Yes, we calculated that. So post-tax profit, and by applying the P ratio method and adding the additional cash, we got the post-acquisition equity value. So additional equity value created is there. If there is any confusion, you can ask. Now, the next is the next requirement is an estimate of percentage gain in the wealth under the cash offer. Very easy. What is the cash offer? $8 being offered to both, yes, Skull Company. $8. Okay. So percentage gain in the wealth of both companies' shareholders. So just see here. So Skull Company, their current share value is here 6.6. Pre-ac, they are being offered $8. So cash offer 8 minus 6.6 divided by 6.6. So percentage gain. Now, what is the value? Now, you see here. Focus everyone. Focus everyone. So, which was easy to calculate for the shareholders of Skull Company. What is we know that the current market value of Kampai company share, it is given above, that is 4. What is the additional value for them? So now you see here, so 21.3%. In other words, if I calculate 8 minus what is value per share in amount? 6.6 current. So they are being 6.6 value per share, gain per share. In amount, in dollars, they're being offered 8. Current market value is this. So what is the total gain for Skull Company shareholders? What is the total gain? You see here, same 1.4. So 40 million shares Skull Company has. This is the total gain, which is attributable to Skull Company shareholders. Remaining gain is for the Kampai company. So this minus this. Remaining gain is for the Kampai company shareholders. And Kampai company has 225 million shares in issue. This is the value gain per share. Just like that, I calculated this gain per share for Skull Company shares. Gain per share. So percentage gain, what is it? C8, it is the value per share. 4. Current value per share. Kampai company. Percentage gain. So percentage gain is also calculated and amount of gain is also calculated. It was a bit, okay, it was not that tricky. Yes, this was a bit, I can understand. Okay, now, so any confusion, you can ask the question from me. Any step you want me to re-explain, I'm here. Now, let us proceed further. Let us proceed further. So the next question is an estimate of number of shares allocated, share for share exchange, because they wanted a certain percentage. There's a 50-50 distributed. Additional value created is 50-50. So additional value created is 174.5. So 50-50 for each. Here you go, 87.3 million. And then what is the Kampai company's shareholders value? So current value was 900 million. We calculated above. C9. Here it is. You see. So share value per share value. Here. So value for skull companies. Current value D60. Okay, D60. Here. Additional value plus B23. What is B23? So B23 is current value. Current value of equity plus additional value of share. We simply added shares in the value of both. Now share for, so this, here is the problem. So how many share, now what we did? Current value plus additional value. Current value plus additional value. So this divided by 225, which are the current shares. So this will be the per share value. Now listen, share for share exchange. This is the value Skull company wants. And one share value is 4.39. Per share value is 4.3. So how many shares to be issued? Number of shares to be issued. Value they want divided by per share value. So Skull company has 40 million share before acquisition. So they are going to be issued 80 million shares. So 2 shares of Kampai company for 1 share of Skull company will be issued. So 2 for 1 share. So now the gain, because they wanted gain, conditions are there. 25% in the cash offer and 33%. For the cash offer, we have calculated already. Now, so for, yes, just see here, increase 33%. What is it? This is the current value is $4. So B25, just a minute, please. B25. It is $6.6. So $6.6. So you see here, 2 for 1 share. This is the value they will be getting, 2 for 1 Skull company. So I have multiplied this. Minus their current share value, which is here above 6.6. So percentage gain. So Kampai company 4.39 minus 4 divided by 4. So percentage gain is calculated. Okay. So students, this need to be considered once again. I will repeat. Share of additional value, 50% of total value. So Kampai company current value plus this. Okay. So per share value of Kampai company, 225 million. This divided by 225 million. This is the value. Now, value for Skull company after acquisition. Current value plus this. So they want this value. So how many shares should be issued so that they get this value? So this total value divided by value per share. So 80 million. They have currently 440 shares. So 2 for 1 share of Skull will be issued. And 2 shares have this value. Current value is 6.6. So percentage gain can be calculated for Skull company. And Kampai company's current value of share is 4. Percentage gain can be calculated very easily. Now, report to directors. Before I proceed, there is a question from a student. Can we look at post-acquisition value? Okay, sure. I'm sorry, I didn't. Yes, this one. Basically, what is it? This is the revised profit into PE ratio. Into PE ratio. You know, what is the value of market value of company? PE ratio into profit after tax. The same we have done here. Plus, the question has added a complexity. They say they will get additional 40. Yes, it was here. 2.3 million cash from closure of recently established factory. So we have to add that cash as well. Is that clear? Is that clear? Tell me. Actually, okay, a good question. They say why we consider pre-act value of 17 profits? Because the post-act profit is based on pre-act profit. We need to calculate post-acquisition profit based on this data. They say Skull company's profit after tax is expected to increase by this. This is additional amount given. So pre-act we need to calculate to add to this and then multiply the PE ratio. Is that clear? Okay. Now the remaining parts of the question. A discussion of acceptability of cash and share-based offer with the assumptions. Very easy. First of all, what we will be doing? Report is here in front of you. The report includes all the requirements are here. Summary of results. Under cash offer, what is percentage gain? We have calculated above. Under share for share offer, we have calculated above. Summary of results. Okay. So you see here, Skull company is getting huge, but under cash offer, they were saying they are ready to accept only when there is 25%. If you remember that, they said that 25% gain should be there, and 33% for the share for share. So share for share, their condition is being met, but for cash offer, it is not being met. Okay. So Kampai company shareholders, they make smaller. However, it is acceptable. It is strategic important company for them. Okay. So cash offer is 21%, does not meet the requirement of 25%. So they may need to raise the cash. Okay, right? So the share for share offer meet the requirement. It may be acceptable. However, Kampai company shareholder may move because their percentage gain is very small as compared to them. And they are going to lose their control as well, the way they have right now. Now, so discussion is done. Now, assumptions are going to be started. You see here, this discussion can be done by a person having minimum knowledge. Means you need not to be something very good at financial analysis. It is in front of you, the data. Yes. Assumptions. Okay, right? So assumptions have been made. First of all, the free cash flow method is used, growth rate, cost of capital. Okay, they are all estimates. So use of Kampai company ratio, that is right or not? Assumption. They say factory can be sold for 442.3 million. We don't know it is certain or not. So yes. So additional value created 174.5 million. That is subject to uncertainty. It is not definite. And very important, which I told you, the calculation apparently is focusing on Skull company's additional value. But what are the energy benefits to Kampai company that may not have been considered? The strategic importance now. Enough. Tell me, is it difficult to write what has been written? Let me tell you, this is examiner's answer. Remember that. This is examiner, not my answer. I have just presented in front of you examiner answers for analysis. Is it difficult? How many marks? 7 marks. How easy they are. Now, okay. Financing the acquisition. The next part. Kampai company has minimal spare cash resource. It is very close to breaching its current debt covenant. So cash offer is very difficult for them. Challenging. Kampai companies, finance sector suggested that a mixed offer should be considered. That FD thinks that offering cash and some shares to acquire scale company would be better choice. Okay. So now 7 marks. So two issues, financing issues and option of mixed offer benefits. So if you distribute marks 3.35, 3.5, it will be easy. The shareholders want 25% value. Okay. So they will get cash more than 8. So cash is not available. So they may need to raise new equity or debt finance. The company, Kampai company. Okay. It is already closing another asset. Okay. So company is already on the verge of breaching covenant. So debt finance doesn't seem to have an option. Okay. And its risk profile is already high. And raising equity is also difficult because attractiveness for Kampai company is small. Okay. So now, the problems with the raising funding. We have not to provide solution. This is financing issues. Discuss financing issues. We have discussed why they cannot raise debt, why they cannot raise equity. 3 to 4 points have to be made. Okay, right. So raising finance, it could impact companies' capital structure negatively. Now, a mixed funding offer of cash may reduce some of the financial issues, although it is unlikely to eliminate them completely. Yes. So a mixed offer. So existing shareholders, yes, between exactly because skull companies, oh, you just see here with the cash offer, they're getting this. With share for share, they're getting this. Reduce. So when they offer do mixed offer, they try to bring them down from 33% and increase share of current shareholders so that you can convince your shareholders. That's it. So a mixed offer would give the opportunity of cash as well as in the future success of Kampai company. Now you can see yourself. It is done. Now the last closure of the factory. How to address? Now this is the point. Closure of the factory. How to discuss it? Come here. So the requirement is how they may address negative comments. Skull Company has a recently established factory producing vehicle which used hydrogen power. Kampai company is of the opinion that factory is not financially viable and does not align with the Kampai company's strategic direction. They therefore thinking of shutting down the factory down once Skull has been acquired. They expect to generate immediate cash of 42.3 million. An internal memo about the possible closure of the factory was obtained and published by Popular Press. The resultant reaction from the media and the general public has been negative. The negative reaction centers around the job losses in an area which is less developed. And that disclosure will be a step backward from sustainability. Remember, they are famous for sustainability. Remember? Skull Company. People have been particularly vocal in their criticism, suggesting that Kampai company would be going against its core business values and destroying its reputation. Kampai company's board is very concerned about this development. One director suggested that Kampai should not close. Other director suggested that they should not proceed with the acquisition at all. Overall, Kampai company board thinks that these relations may not be viable and has asked for advice what action should be taken to deal with the negative comments. Now, so so we have to start with yes, these negative comments are going to harm. First of all, in relation to sustainability, company's reputation is related to sustainability, taking care of employees. So when they are seen in the press going against all this, it will affect its reputation and value of company as well. Now, so if they do not now, on the other side, if they do not close this factory, what will happen? What will happen? And now it is against the Kampai company's strategic direction. So if they have to acquire this company, they need to close it down. So what they should do? They should not respond to the negative comments. Rather, they should explain how this action is in the best interest of company's overall stakeholders. So they can start a media campaign that that how what companies actually no counter campaign that how companies actually working on sustainability on other aspects on other fronts as well, how it is, and it may offer some trainings, some alternative jobs to the redundant employees. Possibility is there, right? So yes, of course, this is all done with the cost benefit analysis. For example, if the company does nothing, what will be the consequences? But if company starts promoting its positive image, its other action, it start projecting. So what will be the cost and benefit? Right? So this is how it should be discussed. Now come here. So just see here. Factory closure. So negative comments are there. Loss of reputation. Corporate value may go down. But if they consider people, the company will compromise strategic direction. That's why they should proceed with the closure. Because company has to watch its interest. So this negative comments are how to be dealt with. It should explain that it is in the best interest of company, what they are doing, and stakeholders, and they should launch a media campaign, how they are going to address, how they are, what they are offering, other jobs, trainings, doing other actions, and for environment and sustainability. Again, cost benefit analysis. Doing nothing, and against the cost of the initiative. Conclusion. The appendices to the report estimated value and how value is shared. Kampai company should accept both offers, but Skull companies may demand more in the cash offer. So that's why, but the values are not definitive. Cash payment may be difficult. Yes. So number of this response. So again, once I've again conclude, summary of everything which we have discussed above. So very easy question. Only the remember where students get stuck normally. Let me tell you, they get stuck when they are doing this calculation. Remember one thing. Let me share the summary marking scheme in front of you. Come here. You see calculations, one mark each point. If you get stuck, 1 mark means you need to spend how much time? 1.8 minute maximum. If you get stuck somewhere, do instantly what you are getting understanding of. Right assumption over there, move. In AFM, the best thing to do is keep moving. Don't get stuck anywhere. Don't get stuck anywhere. Remember that. If you get stuck anywhere and you stopped over there, you spent time more than required, you will mess up with your paper. I'm telling you again and again. Because you have to do the discussions in the other parts. Maximum, you will write one calculation incorrect. One calculation. Maximum. 1 or 2 or 3. 3 marks you lose. But here you need to write 7 marks. You need to complete 7 marks. How you will be doing that if you get stuck here? It is not wise to spend more time here. Please remember that. Okay? So if I say over here, 40 marks question it is, right? 40 marks. And you have 90 minutes to solve. 15 minutes first, I ask you to do analysis of the question and requirements. So how many? This divided by this. 2.25 minute per mark. And they are more than enough. They're more than enough, I'm telling you. You should be spending 2 minutes per mark. You can do it. And where you get stuck, take assumption, move on. Complete the next part, come back to the previous one. This is the key to success in AFM, I'm telling you. I don't suggest this in AAA like this because that has different mechanism and scheme to